Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, and welcome back to the Wade Borth Podcast. Today, we have a special guest with us, Brandon Cobb. Brandon comes to us all the way from Nashville, a city that I enjoy. Been down there and had some fun in. But Brandon lives there. He sees all the crazies like me come and go on a regular basis and come across some content that might be useful to you. We talk about money has to flow and what are we doing with our dollars to grow wealth. And so hopefully today Brandon might give us a couple great ideas, maybe spark your interest, spark your imagination. I need to reach out to this guy because he's saying something that I want to hear. So again, Brandon, thank you for taking the time to join me and welcome to the podcast.
Hey, Wade, nice to meet you. I appreciate you having me on. It's an honor.
You bet. So Nashville, have you lived there all your life? Is that something that you moved to, or is that something you just have stayed at?
No, so I moved here about 7 years ago, 2014, I think it was. Grew up in Memphis, went to school at UT, probably went there for the worst 4 years of UT football history ever, and finally got my first career job, moved to Nashville. I've done everything from building product sales to selling medical devices and, believe it or not, selling neighborhoods now.
Selling neighborhoods, I like that. So, well, just to give you a little bit of an introduction to Brandon, you're the CEO at HBG Capital, which is a expert real estate consultant and investors, right? Or did I just butcher that? Maybe you can fill the holes in there.
Yeah. So we are a vertically integrated real estate investment firm, and what we do is we help investors build a legacy, achieve their dreams, and impact those around them through unique real estate investment opportunities, specifically to create passive income that's designed to be insulated against market volatility.
Yeah, and I think this is where the interest is, at least with my clientele, is again going back to the whole idea of what I teach and what my listeners for the most part are hearing. Is that, hey, we're building this reserve of dollars. We have this guaranteed bucket of money. And now what do we do to put it to work? And one of the things that I like about what you're saying and what you're teaching is consistently you use the word system, right? You have a process or a system I think you use the word process, but to me it's kind of the same thing. And I'm a firm believer it's the process, not the product. That is the part that people have to embrace before. Because if you have the right process and you're not focusing just on the product or the outcome, that's what's going to probably save you a lot of headache in the future. Would you agree?
100%. In fact, my fiance and family probably get sick of the word system and process, so I get joked about it all the time because I try to break everything down into a system and process.
Right. And why is that? Tell me, why you like that idea of having a process versus. And again, I use, we use properly structured life insurance in what we do, but everybody wants to focus on that. And I said, that's the product. I said, but if you don't have a process to go along with it, it's like having all the tools of a great carpenter, but none of the skills. That's kind of my example is like, if you don't have the mastery of the skills, then the products you have, the tools you have really don't do you any good. That's always my analogy.
I've always needed structure because I don't like surprises. And my thinking is I'm not going to be able to completely eliminate the surprises that happen throughout my life. And whether it's our investments or, my personal life, whether it's my health. But if I've got a system and I've got a process, at least I can minimize the number of surprises. So I think that's where it all started.
Yeah. So with that, what is the process that you have for, it's building homes and also building businesses, right? It's what does that process look like from an outsider to, if you were going to give them the Reader Digest version of what that looks like, maybe just so let our listeners know kind of where you're coming from in that process. And then at the same time, how does that apply to the product or to the what you're doing for your clients?
Yeah, so the whole goal is to put as many layers of insulation between us and the market. And this is, I'm talking business sense right here. I've got whole other systems and processes for, working out and health and all that. And maybe we can touch base on that. But really, it starts from a high level and drills down. So I like at it like a waterfall, where that water comes down and it's hitting multiple rocks. And each rock that it hits is a layer of insulation that's preventing you from getting hurt, right? How can you protect your principal? The whole goal is capital preservation. If you talk to the billionaires out there, they're focused more on capital preservation, not just super high returns. So how do we do that? With us specifically, it starts with selecting the right market. There's a ton of great markets out there. We're really bullish on Nashville for a few reasons. One is it's affordable compared to the rest of the country. When you've got an economic contraction, certain needs don't go away, right? The need for vacations and luxury items probably going to take a pretty big hit. The needs for living and groceries and eating, that need's probably still going to live there. So certain needs go away and certain needs actually get amplified. And so that need to live, people don't live in these luxurious arrangements. They look to cut costs and pinch pennies. And so they'll transition to more affordable living arrangements when they don't have as much money and their pocketbook is filling it. So the areas of the country where you have that affordability and the demographics are still very attractive, that's where we want to be. And Nashville is that. So if you look at the prices, compared to the rest of the country, if you look at how much growth is happening. So the second reason we like Nashville is it's been the top 10 fastest growing city in the United States the past 7 years. I mean, it's nuts how much is moving here. And there's a lot of reasons for it. The no income taxes make it very attractive from a business perspective. If you're in a very high tax state, New York, California, I mean, there's a great migration coming to this city because business owners want to move their people here because it puts more money in their pocket and it reduces the amount of taxes the business has to pay. So that's created a really great environment. From another, a new perspective, COVID, now if you're an institutional lender or you're, buying and flipping businesses, whatever, if you're just looking to place money, you no longer want to be in the markets that shut everything down during COVID. You want to be in the markets that were for business and help the businesses, especially the small businesses that grow. So Florida, Tennessee, we didn't shut everything down. That's another attractive quality about Nashville. Yep. From a local perspective, we really focus on homes that are targeting first-time home buyers. And the reason we do that's really simple. It's the most undersupplied, highest demand real estate product in the country right now. I mean, you see it on the news every single day. Where's the affordable housing? So not to be confused, because a lot of people hear affordable housing, they think Section 8 or government housing. We're not talking about that. I'm talking about how do we get a starter family in their first home? Nobody can afford everything. That's why you see all these build-to-rent phenomenons and rents going through the roof. Nobody can afford to buy anything. So that's what we want to do, where there's high demand and low supply, because when you do have a contraction, not all real estate products or sectors, for that matter, in the economy get affected the same. Certain sectors thrive. Certain sectors take a really big hit, right? You had office space and, restaurant retail took a big hit back in 2020. 2008, 2009, it was single-family housing. Before that, it was the tech bubble. So we try to mitigate everything from a high level to make sure we've got that insulation. And then from a local perspective, we manage everything. So we're vertically integrated. We build all of our own products. We're not hiring out a builder because we saw too much risk if that builder were to go belly up, bite off more they can chew, get hurt, injured, whatever have you. All of a sudden, your whole portfolio is at risk. And we didn't want that. So we built out the construction arm so that we control every single thing in-house from start to finish. And what that did was it just aligned the builder's incentivization with the investors. So everybody we work with knows, hey, look, we're handling everything. We're not depending on an outside source. So, we felt like adding all these different layers and being able to get in and out quicker than, traditional investors who have to pay a builder, limited our market exposure and provided us a lot of advantages compared to the rest of the country.
Well, I appreciate that. And so that was actually one of the questions I had is, you mentioned a vertically integrated real estate firm, and I'm a simple farm boy from North Dakota. That's where I live, right? So I'm like, what does he mean by vertically integrated? So thank you for the clarification. Basically, you do everything from soup to nuts. I guess that would be the terminology we'd use up here. So, but it's so valuable to be able to control all the processes, because now you're not dependent on somebody else to slow you down or stop you or that type of thing, right? Is that fair to say?
That's fair to say. You got to think about it. If you've got all these different arms that you're dependent on for your business to thrive, what happens if an arm goes out? Right? It's a disaster. And so It's tough to scale with the vertical integration, right? Because you're kind of limited to being local unless you're very good and you can nationalize. For us, we see a ton of opportunity here in Middle Tennessee. I mean, the sky's the limit. Long term, people were saying like this is the next Atlanta, right? Some of those guys who've been in the business for 50 years, Nashville's a long term play for us. We see a ton of opportunity here.
Right. That fits in really with my founding principles, right? To which I think a lot of my clients, the people listening to the podcast have is that, and I'll just lay those out as, we want people to think long term. Obviously, there's a lot of short term opportunities, but those aren't necessarily what we want to focus on. We want a long term process. We want a long term strategy. And when I say long term, I'm talking not even my lifetime, but really generational lifetime, right? If you have a process that works well, and then we can teach that and pass that knowledge on to the next generation, which is the next pillars. Like we want to make this intergenerational. That's the real key. And then, and I'm a firm believer that, God has put all the knowledge that we always need in our head. But the problem is there's a lot of weeds. It's like my garden. If there's a lot of weeds growing up around everything that I'm trying to grow and trying to nurture, that kind of gets lost. So my job is to help empowered people get rid of the weeds that are in their garden so they can nurture and grow either the flowers or the fruits or the vegetables that they want to grow. Being a farm boy, everything comes back to the farming sector, right? So it's about that same process. But and this is why I think what you're doing fits so well is that it is a long-term process. It is a long-term thought process. And the idea that we want to avoid the losses versus, concentrate on avoiding the losses, then you don't need the huge gains in order to make up for those losses. It's, that simple concept is lost in so many people because they all want to be that person that says, hey, I had a 300% return on my investment. Yeah, well, it's kind of like my mother. She used to like to go to the casino when she was alive. And she'd always tell you about the time that she made money, but she'd never tell you about the time that she lost money, right? And so she needed to have those big days to make up for the days that she didn't make so much money.
Yeah, no, you got it right on the head. It's interesting. It seems like the higher returns a lot of investments offer out there, the more risk there is.
Right.
My dad he just lost, and it wasn't like a ton of money. It was some play money, but he literally lost everything from this like Bitcoin Ponzi scheme where the company was saying, hey, we're going to arbitrage the difference in the different trading platforms, like buy and sell prices. And he's gung ho about Bitcoin. And so he invested, I don't know, like a few $1,000s, and, Lord was up. He was generating like 30-40% returns per month. And a lot of people got sucked in and they started investing more and more and more. And then all of a sudden everyone got a text or an email saying like, hey, we've been hacked. All the money's gone. And they just, just a front for, we ran off with all your money.
Ouch.
So it's very important that when you're vetting people to invest with, there's a lot of things to look at. But, what we teach on our website, we've got a free ebook, 100 questions passive investors should be asking before investing. And you can grab it at hbgcapital.net under the educational resources tab. But it's designed to take somebody who might not understand something when it comes to real estate, specifically with new construction or multifamily. Like those are the two areas that we like to dabble in, and become, I'm not going to say an expert, but at least what you should be asking the sponsor when vetting a deal so that you can pull the information that you need out. I'd say that's the biggest mistake I see people make when investing is they just don't know what questions to ask to get the information that they need because they've never done it before. So if you're armed with the right questions to go into battle, then you can make sure you don't make a bad investment. Really, investors should be looking at two things: the sponsor and the deal. I mean, you could have, Jesus Christ himself come up and put a deal up, and he's got the best integrity out there, and he's gonna deliver, right? This is a good human being. He's not gonna run away with your money. But if he does not have a good deal, it's not a good decision. And vice versa. You could have the best deal in the world and know, man, these numbers work. This is a great opportunity. But if you've got a bad operator that's running that deal, then that's a really, really big problem. So we always teach people to vet the sponsor and vet the deal. Those are the two things you need to be looking at. And that sort of simplifies things when you feel overwhelmed about analyzing some new investment.
Yeah, I think that's a great point. One of my favorite books is called The Richest Man in Babylon. I don't know if you've read that or not.
Yeah, great book.
Talks about, having in your corner and I'm paraphrasing obviously, but those that have the expertise, right? Those that have knowledge, and finding those people and having be trusted advisors to you. And again, I'm not endorsing Brandon or his organization, but I think it's a great opportunity. And what you're saying is exactly spot on. You don't need to become the expert, but you also need what you need to become is at least knowledgeable in what you're doing, and then so you can knowledgeable enough to find the right people that are the experts. Is that kind of what I heard you saying?
Not just the right experts, but they've got the integrity, to follow up. We've got a whole process for vetting, sponsors that people need to follow. Really, make sure it's almost like, think about if your daughter's getting married or your son's getting married, right? You want to meet the lucky man or woman who's marrying your son or daughter. I mean, that's the type of perspective that you need to have when you're interviewing these sponsors. You need to make sure that a good fit for your child, and your investment's important too. You need to make sure they're going to be a right fit for your investment. So making sure you can ask them the right questions to pull that information out it's really important.
Yep. I would agree. So, hey, I'm going to go back to something you said earlier, which I think was really important. You were talking about this vertical integration and how important it is to control all aspects of, from acquisition of land and building and the sales. How important that is. And that's from our teaching. What we teach our clients is that by controlling the banking function, you're kind of doing the same thing. And I kind of like the way you used it, and I want to kind of get this message across, is that by controlling the banking function, we're doing the same thing. Is that we want to control that vertical integration of, if we have to wait for somebody to give us the thumbs up or thumbs down to either move ahead with a deal or not, because somebody at Wells Fargo or Chase or Bank of America is giving, we have to go there for the loan, then who's really in control of that function, and really who's in control of our business? And that's kind of what I hear you saying, is that the more you can control, the more freedom you have to make decisions in a lot quicker fashion. And I think that's the part that people miss, is that sometimes it isn't about, it's about how quickly you can move in the marketplace, because there's opportunities that come by that aren't going to be there for a long time, and or the ability to get in or the ability to get out in a really fairly, in a quick fashion relative to what everybody else is going to do. Because you're in competition with everybody else, so how quickly you can move within that marketplace is a real key.
Yeah, and whole term life insurance is a fantastic product, and it does. We were talking before we hopped on here about your client that you had that 2008 happened, and he saw a property that he was interested in, and it was 60% off. I mean, he could buy it for 40 cents on the dollar. And, there's great deals out there when that happens. The problem is there's no financing, right? Lenders don't want to lend anything. Whereas right now it's a weird environment because there's more money out there than there are deals, and it's really hard to find really good deals. And so the market pivots, but being able to have access to, whole term life insurance and be able to borrow against it and buy things very quickly and act, that's a huge advantage. The market goes up and down in real estate and stock market. It's being able to identify those times to take advantage and be ready. And I think that's what, whole term life insurance does a great job of, is it allows you to be ready when the opportunity presents itself.
Right. Exactly. And having the, having the ability to move when nobody else can move. I think that's the real key. And that's what I, see with you guys when you control all the processes, that you don't want something holding you up because somebody else has got an issue, right? They got an issue with employees. They got an issue with, like you said, they took on too much work, and now you become second fiddle to somebody else. When you control all those functions of your business, that makes your business a lot more valuable. And again, that's where you can either save yourself or you can really increase your profits, is when you can move quickly and when you're not dependent on somebody else. So
that's right. One of the biggest risks you have with any investment is market risk, right? How much time is your investment going to be locked up? During what market conditions you're facing? So the quicker you can get in and out of these things, the less likely you're going to take a huge hit. We're preparing for a hit. We know our portfolio is going to get affected by the economy at some point. That's why we look for unique opportunities. Right now we're building first-time home buyer homes. Why? It's the most undersupplied, highest demand real estate product in the country. I don't really care what the economy does. people need somewhere to live that's affordable. And maybe it won't always be like that, right? But the reality is if we can buy these deep discounted deals in an asset class that's got very high demand, very low supply, and we can buy these things at 66, 67% LTV where there's a big runway in the event that something just does happen to the price, and we can take that hit in the 12 months or less that we're in and out of these assets. We feel like that gives us a lot of insulation, and I think that's what a lot of people need to look for is what are the current conditions of the market and how fast can you get in and out of the investments that you're thinking about investing in. And it'll all be relative to the individual investor. You might not be concerned of it if your investment horizon's 30 years and you're 40 years old or 30 years old or something like that, and you're going to keep it parked up. But for some of the older population where you can't take a 30% hit when some virus comes over from China and the stock market tanks in 2 months, if you can't stomach that volatility, that's really who we're a good fit for. People who want consistent of income that's insulated against events like that.
Yeah, that's a great point to be made. Is when you look at your who's your ideal client, and which one of the listeners out here say, hey, I need to know more about what Brandon is saying. What do they look like? What is that your typical investor look like? I mean, is it somebody that's got millions of dollars, or is it somebody that says, hey, I got some dollars, it's not all my money, I'm assuming you have to be an accredited investor, correct?
No, not necessarily. We work with both accredited and non-accredited investors. If you're non-accredited, there's a few more hoops that we have to jump through. So the SEC does want to see a pre-existing relationship. So there's a number of phone calls that we have to go through and make sure that you're educated on everything. But yeah, we definitely work with non-accredited investors and accredited investors. As far as a target avatar, our target avatar are usually busy entrepreneurs who have discretionary income that they're trying to create additional passive income streams for because they want to impact those around them and they don't want to be just reliant on their business to make them money. Now, we work with a ton of people who are retired real estate investors. Like they understand real estate, but they're sick and tired of being a landlord, or they're done building, or they're done rehabbing, but they understand the security and the benefits of real estate. We work with a lot of people like that too. But really, we're a great fit for anybody who's got some discretionary income that wants to build a legacy, achieve their dreams, and impact those around them through unique real estate investment opportunities.
Obviously, I have clients all over the United States, and we have a lot of listeners all over the United States. You're regional or you're local as far as where you're building at, what you're doing, but you have people that you can work with all over the United States, right? Is that fair to say? You have investors that are located in other locations.
Oh yeah, I'd say more than half our investors aren't even local.
Right.
Yeah, that's we've got a lot of people in our network, but the majority of investors are just people who've been referred to us through our existing investor base, where they find us through platforms like this and reach out, set up a phone call, and we just get to know them. And it's a relationship game. We love getting to know all of our investors. It's a lot of fun. And we understand that, people got to know, like, and trust you before they're going to give you any money, and it's got to make sense for them.
Right. Well, if people are hearing this and they're listening to the podcast, how do they find you? I think you threw it out a little bit earlier, but go ahead and give your contact information. We'll put it in the show notes for people, because if this is of interest to you, if you're thinking, hey, I need to, again, start the process, vet Brandon, make him run through all the hoops that you want him to run through. He looks like he's very athletic. He looks like he could jump through a lot of hoops. Make him do all that, because that's important. I think it's important for people to do a good job of due diligence when they're going to put money with somebody. Again, I'm not here to endorse him. I just like the ideas. I like his values. So how do they get a hold of you, Brandon?
Yeah, so if you are somebody who's interested in learning more about recession-resistant real estate, if you're trying to build a legacy for your family, if you're trying to create passive income, go to hbgcapital.net. That's Harry Bob Gary Capital.net. .com wasn't there, couldn't buy it, so we get stuck with the .net. We've got a book on there. It's completely free. It's called Recession-Resistant Passive Income. It breaks down everything we do, what we like to invest in, and the reasons why behind it. We've got that other ebook on there in the educational resources section, 100 questions passive investors should be asking before investing. I personally think that should be required reading for anybody who's thinking about investing in real estate and is new or even seasoned. I guarantee there's questions in that book that you have not been asking that you should be asking. If you're somebody who's interested in wealth preservation, long term, like I don't want my principal to get affected, this might be something that you're interested in, because a lot of people, we don't know what the economy is going to do, right? A lot of people think, oh, the recession might be here for, 2 quarters and that's it. But, what if we get the stagflation of the 70s? Or,
Right.
What would that look like to you, your family portfolio? What does that look like to your kid's college fund? So, feel free to reach out to us if you want to schedule a one-on-one call. We'd love to get to know you.
That sounds great. To that point, there was a guy that studies demographics for it, but he was making the point that we are 25 million houses short in this country.
There's so many statistics out there. It can be a rabbit hole just finding who's right and who's wrong. But
Right.
It all started back in 2008, 9, 10, and 11. Everything shut down. Real estate. I mean, everything. You had the whole financing industry completely locked down. So you didn't have any inventory hitting the market for like 3-4 years. That is
Yeah.
long time with an exponentially growing population in the, what I consider the greatest country in the world, thriving. That's a long time not to have housing. And so when COVID hit, we weren't even caught up yet. And COVID, all it did was shut everything down for another year and a half. So it just exacerbated the problem. We're years away from catching up to the current housing demand. Now, that doesn't mean that things couldn't flip-flop in the opposite direction, right? Anything's possible. If interest rates go up to 15%, that's going to have an effect on housing. But again, it's just going to exacerbate the problem.
Right.
Supply and demand. We don't have the supply right now for first-time home buyers, let alone other home buyers as well, it seems like. But you get a trickle effect when things do change. So when you get higher interest rates, when it announces that we're going to war with whoever, when the recession occurs, you do have a trickle-down effect with real estate. And the first product types that get affected are those higher-priced homes, the $1 million, $2 million homes, because your buyer pool is so much smaller. And when interest rates go up, their mortgage goes up a whole lot more. We just saw an increase from 3.2% to 5.3% in 30-year mortgages. Well, for our target demographic, it only increased their mortgage by like a few $100s a month. That's really good. Whereas the higher priced stuff, people are getting priced out now because they can no longer qualify for the mortgage. So there's a ton of statistics out there, but, pay attention to what is the need. What are you hearing in your circles? What are you seeing yourself? There's a lot of stuff that happens on the news. No better data is raw data, in my opinion.
Yeah, I would agree with that. So, because that is a good point. I mean, I've looked for years, like, I don't know how, you're looking, it's like, there's a huge need for those people that want to buy their first houses, but how do they come up with that kind of down payment? How do they come up? I mean, and this is really what we're trying to teach people is when you control that financing, that's the most important thing you can do is control the financing, because then you're not at the whims of somebody else to tell you what you can and can't do. So, I have a couple more questions for you. You talk about, this is passive investing with what you do. With that, do you get the tax benefits of owning real estate when you do that, or is it because you guys are acquiring, building, and then selling that there's really not that kind of tax benefits that go along with what you guys are doing? And then the other side of it is, do you need to be a real estate professional in order to get those?
Yeah, great question. So with the single family stuff that we do, because we're building and selling, there's no depreciation benefits. So with that, there's no benefits. When we do acquisitions for commercial or multifamily, like we also like to focus on Class B, Class C value add multifamily, that there is, because you're buying into it. We'll do a depreciation on that asset, and we'll do a cost seg study, recapture that depreciation. And because investors are actually purchasing units of ownership in the syndication, they get a K1 during tax time, which means they're an owner, which means they get to receive some of those depreciation benefits.
Okay, good.
As far as being a real estate professional, the real estate professional status works great if you're receiving passive income from real estate investments, and you want to be able to write that off, right? If you can figure out how to get don't quote me on this, I'm not an accountant, but I think it's like 750 hours a year, something like that in real estate to get the status. Because I'm a real estate, professional in the IRS's eyes, I get to write off all of my expenses and all the income that I get from real estate, which is great. Where a lot of other people, if you don't have that status, if you're, let's say you're a lawyer and you're not spending 750 hours a year doing real estate, you wouldn't be able to write off a lot of those benefits that you get, the tax benefits. So just be careful before investing. That's a great question to ask the sponsor, by the way.
Right. And it's, I'm a firm believer that you don't let the tax tail wag the dog, right? Don't do something for a tax reason. If it's there and it presents itself, take advantage of it, but don't do something solely based on a tax situation because, again, it's the government's game and they're going to change the rules on you. So the instant that you think you have it figured out, they're going to go ahead and change the rules in the game. So if that's the only reason you're doing something, I would just caution you to be careful, for the listeners out there, like, oh, I'm going to do this because I get a tax advantage. Well, I can go out and lose money and I get a tax advantage if I have 100% loss on a property, but that doesn't do me much good, right? No. So just don't let the tax tail wag the dog. But it's just a question I get a lot from my clients is like this idea of investing in real estate and we're talking about passive income versus direct ownership. You're in the syndication, but which is a form of direct ownership, by the way. And so there's advantages that can be passed along to you if that's how it's set up. I think that's what I'm really trying to say. So ask the questions. When you're talking to Brandon, ask that question. Don't rely on me to ask the question for you. So.
Yeah, grab that book, 100 Questions Real Estate Investors Should Be Asking Before Investing on hbgcapital.net under the educational resources. That'll cover every question you need to ask a sponsor, and that's a really good one.
Very good. So I should have read the book before I had this conversation with you. So, at the end of the day, what's the biggest mistake people make, or I don't say the biggest mistake. What's the thing that kind of holds people back from being successful? Working with somebody like you? Is it just finding the wrong people, the wrong investments, or just not asking enough questions? What is it that, if you could advise people to do just one thing, what would that be?
Create a system and process around vetting sponsors, and we're happy to walk you through that. So again, I'm beating a dead horse here, but a lot of that process and system is in that book that I wrote, asking all those right questions. So when you're vetting a sponsor, you want to see their track record, right? Don't go off some kind of portfolio that they sent. Like, actually do the due diligence, see, did they actually own these assets? How many exits that they have? If you're vetting someone who's doing single-family new construction, ask to see a history of all the homes that they've built with addresses. How much did it cost to construct? How much did you sell it for? That'll tell you how much profit they made on it. Have they ever lost an investor money? These are all questions that you want to ask somebody who's doing what they're doing to make sure that they're a fit for it. You want to have the track record. Next, background search. Nobody does this, but that is the best tool you can make. I hired a general contractor one time and did not do a background check on him. He ran off with like $15,000 worth of my money. I made a huge mistake paying him, but that was a lesson learned. And then I pulled a background check afterwards, and he had like a rap sheet that was super, super long, and I was like, oh, well, this is dumb. So make sure you get a background check on him. Have multiple meetings with him. So your gut is a great asset for you. And a lot of people don't listen to their gut. Have multiple meetings. If you can, depending on the investment amount, maybe invest the money to fly in and actually meet them and see some projects. A lot of investors have actually flown in to see some of our stuff. They've met us at the office. They've seen one investor actually got he had a pretty sizable amount of money. It was several $1 million he was looking to invest, and he had a background in construction. So we flew him in town. He actually got to sit in during a team meeting and see everybody and see how we run team meetings. We gave him a tour of all the projects. We showed him the numbers. We opened up QuickBooks and said, hey, here's what we bought the property for. Here's the construction budget. Here's the loan. So he could actually see, touch, and feel it. I actually really enjoy doing stuff like that. So, do as much due diligence as you can. Meet with them multiple times. Get a good feeling for who they are. Ask them questions that you already know the answers to see what their integrity is, right? You want to make sure that they're telling you the truth, and the only real way to know if they're doing that is to ask questions that you already know the answers to. And ask for referrals. Ask for other investors. Say, hey, do you have 3 other investors who've invested with you long term that I could speak with? We've given out referrals before, as long as our investors are okay with it. So these are all things that you can do. You need to create a system and a process for vetting the sponsor and vetting the deal. And with the deal, the number one thing that you're interested in, because you've vetted the sponsor at this point, they're going to perform. They've got the track record. They passed the background test. You've talked to other investors. You've got the referrals. With the deal, I want to know how big of a hit that deal can take before my principal is affected.
Right.
If you're investing in multifamily, I want to ask them, hey, what's the occupancy rate when my investment starts to get affected? What does that vacancy rate have to drop down to? That's important. On a new construction deal, what does the price of that home have to go down to before my principal starts to get affected? That's why we build these big runway ins where we can take these 25, 30% hits in an 8-month period, right? Extreme volatility, and still be okay. These are the types of questions and the systems and processes you need to create as a passive investor to vet your sponsor and to vet your deal.
Yeah. That's a good point, is like just that, know who you're doing business with, right? Understand who that person is. Never thought about the background checks for the contractors, but I suppose why not? I mean, we do background checks and everything else. So that's a great point. So you made a point about you had a big investor come in. From just an average size investor, or an investor say, hey, I don't have millions of dollars to spend. And I don't want to say what's the minimum, because that's not a fair question, but what is a reasonable amount that you say, hey, we'll engage with you, or we'll engage with anybody, but what are we really looking at? Because it's obviously got to be profitable for you, and it's got to be profitable for the investor to come into these deals.
Yeah, so it's usually a good fit for somebody that has at least $50,000 that they're looking to invest. Because we always ask them on the intro call, hey, do you have an emergency fund already set aside? Do you own your own home? There's certain benchmarks that we like to see people hit before they invest, because quite frankly, we want what's best for all of our investors and what's best for all of our future investors. And we'll tell people straight up if it's not a good fit, like, hey, look, we recommend you do this first, right? I'm
Right.
flabbergasted every day when I have a call and someone doesn't have an emergency fund set up and they're looking to invest like their life savings with us. And I tell them, no, that's not a smart decision. Let's set up an emergency fund first, make some other investments in yourself and your home or whatever. And then let's talk once you're ready at that point.
Yeah, good point. So, all right. Well, I appreciate you taking the time, Brandon. I probably could have another hour conversation with you, but like most of my podcasts, I try to keep them short. I'm not one that wants to listen more than an hour, but this could easily go on for another hour, just because you're such a well of information that I think people, if they have any kind of desire to go into some syndication, I love your approach. I love your set of values that you've kind of laid out here. It's like, ask you all the hard questions. You're not willing to, you don't even want to avoid them. You're actually inviting people to ask all the hard questions, the difficult questions, because you don't have anything to hide. So you're able to open up to them. What are you reading right now? Or what's some of your favorite books? And we've talked about like The Rich Man in Babylon and so on and so forth. But what are some of your favorite books that you've read? And just for a little insight of who you are.
Man, I'm a junkie. So I'm a self-help junkie. I have been for the past 13 years. I tend to pick a particular subject, obsess about it, read a lot on that particular subject, and then when I've sort of mastered it, or I'm getting a lot of overlapping information from book to book, then I'll kind of move on to the next subject.
Cool.
Lately, I've been obsessed with Who Not How. So I think Dan Sullivan, I actually keep this book by my desk. You can kind of see it here if you're watching on video. But that is a huge, the whole idea of Who Not How, people kind of misunderstand it. They think, oh, I just need to hire somebody, right? You missed. When Who Not How, it's a strategic partner, whether you're a business owner that is owning a business and you're hiring an employee, or you're looking for a partner. you need to be bringing people into your organization, into your world that are better, or in other words, can teach you how to do that department better than how you're doing it. I used to be a big fan of giving people a chance and an opportunity and growing them and training them. And, we did that, but I realized to really grow really quickly, you got to have a who, not how. So, for example, we're hiring the superintendent role. If they can't come in and look at all of our systems and processes and how we're currently doing things and build a plan to make it better and show us where we're falling short before I hire them, I don't hire that person. So Who Not How has been a phenomenal book. I'm a big fan of it. I love getting inspired by other biographies. I'm reading Will right now. So, Will Smith, I know he's come under a lot of fire lately, but reading his book, I really like his book and his biography, and hearing, the struggles and everything that he had to overcome, because it just puts things in perspective, right? If we all threw our problems in a pile and saw all the other problems everyone else has, we'd probably pick our problems right back up out of that pile and take them with us. So that one's another really, really good book. I like reading autobiographies, and I'm reading that one right now as well. I'm also a big fan of Tony Robbins' new book, Life Force. Currently 60% of the way through that book. Tons of great technology on all of the stuff that's available for your health. And a lot of the stuff that's really beneficial isn't the mainstream stuff. I think you'd be very surprised. So I've invested in some pretty cool technology. I bought a cold plunge, so I'll be doing that every single morning. Looking at buying, a sauna system. And there's some really interesting supplements that may combat aging that I'm kind of experimenting with. I'm a big fan. I'm tested every quarter to kind of see if I notice a change in the supplements I'm taking and how I feel. So I'm kind of split testing that out. Stay tuned, but that's everything I'm reading right now.
Interesting. I love that. I love Who Not How. That's one of my favorite books as well. So I have to go back to the cold plunge and the sauna. Up here in the north, all the Norwegians and the Swedes, they figured that out 300, 400 years ago, is that they would go sit in a sauna, go jump in the ice lake, and then they come back and sit in the sauna again. So they had that figured out, hundreds of years ago. So maybe going back to what was old has now become new. So I love, it's probably a little bit more difficult now to do it, but I found it kind of funny when you said that. So, anyhow. Again, Brandon, thank you so much for your time. I just really appreciate the insight and the thought process you have. This is good stuff. Again, if people have questions, they want to reach out to you, the contact information will be in the show notes. But definitely reach out to him, because if you're not a fit, he'll tell you. If it is a fit, vet him out. Make sure you ask all the questions he's telling you to ask. Read his book. Read that free book, because the more you know, obviously, the better off you're going to be. So again, Brandon, thank you so much for your time. I appreciate it.
Hey, I had a lot of fun. Appreciate it.
All right, take care, man.
Hey, see ya.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button, and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.